All right, welcome back everyone to today's Explainer. I am super thrilled to have you here today because, well, we're unpacking a truly fascinating approach to generating daily income. We're going to break down a highly mechanical, really structured crypto option selling strategy, sourced directly from some recent market analysis. You know, if you love clear rules, defined risks, and literally just taking the emotion completely out of your trades, you are going to absolutely love this system we're about to decode. Okay, let's just dive right into this. To actually understand why this strategy even exists, we kind of have to look at the current market landscape. Historically, traders in the Indian market, they absolutely loved capitalizing on daily expiries. But recently, those daily expiries basically vanished. Traders are now mostly limited to weekly expiries, like the Nifty. But here's where it gets interesting. The crypto market, specifically with heavyweights like Bitcoin and Ethereum, has stepped right in to fill that void. They offer daily expiries. So the opportunity for that high-frequency daily income generation hasn't actually disappeared. It's really just shifted asset classes.
So, here's our blueprint for this explainer. 1. The daily expiry opportunity. 2. Mastering the morning timing. 3. The $100 rule. 4. Setting strict stop losses. And finally, number 5, the 3 possible trade outcomes.
All right, moving to part 1, the daily expiry opportunity.
Now, if you have even just a basic understanding of what a call and a put option is, you already have all the foundational knowledge you need to grasp this. The entire engine of this daily strategy relies on a concept called the short strangle. And look, I know financial jargon can sound super intimidating, but it's actually incredibly simple. All this means is that we're selling an out-of-the-money call and an out-of-the-money put at the exact same time. Why would we do that? Well, because we want to profit from a sideways or stable market. Instead of trying to guess if Bitcoin is going to shoot to the moon or, crash to the floor, we're simply betting that it's just going to stay somewhere in the middle for a really short period of time.
Which brings us to section 2, mastering the morning timing.
The why and how of the strategy's success is almost entirely dependent on when you execute it. It's a very precise day-in-the-life rhythm. Let's trace the global market cycle for a second to see exactly why this timing works so well. Overnight, the US markets close, right? And that takes a lot of the wild momentum with them. Then, between 6 a.m. and 7 a.m. Indian Standard Time, major Asian markets, we're talking Japan, South Korea, China, they open up and digest what happened overnight. Any immediate morning volatility in crypto usually happens right then, which leads us perfectly to point 3.
That 7 a.m. to 9 a.m. window is our absolute golden zone. Think about it. The Americans are sleeping, the Asian markets have already made their big initial moves, and the Indian market hasn't officially opened yet. The source material heavily emphasizes that this specific window provides a really calm, stable environment. By setting a routine to just wake up and methodically place your trade during this morning calm, you effectively remove the frantic, emotional decision-making that plagues so many traders during peak market hours.
Let's move on to section 3, the $100 rule. Okay, now that we have our timing down, let's get into the actual mechanics. Here are the exact execution steps you would take during that morning window. Step 1, open the option chain for the next day's expiry, because that's where the premium is still juicy. Step 2, scan the chain and find an out-of-the-money call option priced right around $100. Step 3, do the exact same thing on the put side. Find an out-of-the-money put priced around $100. You really don't need to overthink it, just match the numbers. And step 4, apply 200x leverage. But crucially, and this is a big deal, do this in isolated margin mode. The source specifically notes that using isolated mode ensures that even with crazy high leverage, only the exact capital you allocate to this specific trade is ever at risk.
So why jump through all these hoops? Well, it's because of this number right here, 25%. If the market stays within our short strangle boundaries, and both the call and the put expire worthless by the very next day, the source calculations show a potential return on allocated capital of around 25%. I mean, that is the ultimate, absolute, best-case scenario for a single day's mechanical execution.
All right, moving right along to section 4, setting strict stop losses. Listen, protecting your capital is the absolute core of any mechanical system. So the crucial point here is the mathematical symmetry of the trade. If you sell that call for roughly $100, you immediately set a hard stop loss at double the premium, so $200. And you do the exact same thing on the put side. Sell at $100, stop loss at $200. This creates a beautifully rigid 1-to-1 risk-reward ratio per side. I actually love this quote from the source material, "Whatever money is to come, only that much should go." It just perfectly encapsulates the whole philosophy here. By setting a 95% take profit order right alongside that double stop loss, you mathematically ensure that you never ever lose more on a single side than you initially plan to gain. You are literally putting a hard ceiling on the damage the market can do to your account.
And that brings us to Section 5, 3 possible trade outcomes.
Let's be radically transparent about what actually happens once the trap is set. Scenario 1 is the sideways market. Bitcoin stays calm, both your options expire at 0, and you walk away with that max profit of roughly 25%. Awesome. Scenario 2 is the one-way market. Let's say Bitcoin just suddenly surges. Your call option is going to hit its stop loss, costing you money, but your put option will expire at 0, giving you the exact same amount in profit. They just cancel each other out, resulting in a perfectly balanced, no profit, no loss day. Your capital is totally safe. But alright, we definitely must discuss Scenario 3, the whipsaw market. This is where the market surges up, hits your call stop loss, and then aggressively crashes down, hitting your put stop loss before the day is over. In this dreaded scenario, you hit a double stop loss, resulting in a negative 25% hit to your allocated capital.
Now, seeing that double stop loss possibility can be a little scary, for sure, but context really matters here. Because of how options pricing actually works, the underlying probability of winning with an out-of-the-money short strangle is structurally above 60%. Yes, the whipsaw days will definitely happen, maybe 2 to 5 times a month, but the statistical probability heavily favors the sideways or one-way market outcomes the vast majority of the time.
Now, for those of you who want to take this even further, the source actually provides several actionable resources. You can completely automate these daily $100 trades using platforms like Delta Exchange or apps like Mirror VIP, which basically let you mirror trades without any manual input at all. If you're interested in how this applies to Ethereum, the creator notes that just commenting ETH on their original post will prompt a dedicated breakdown. And finally, they offer a 5-day crypto automation workshop for 500 rupees. And honestly, it's pretty interesting. It's fully refundable just for attending all 5 days.
So we've covered the opportunity, the timing, the math, and the risks. The system itself is super clearly defined and highly structured. But you know what? The ultimate variable isn't the market, it's the trader. So I want to leave you with this final thought to ponder. Do you actually have the strict, emotionless discipline required to wake up and execute this purely mechanical strategy every single morning, without letting greed or fear alter your plan? It's a question only you can answer. Thank you so much for joining me on this explainer today. Keep learning, stay focused, and I'll catch you on the next one.